somewhere in the back corner of a gas station, next to the lottery scratchers and the energy drink cooler, there's a machine that looks like it does nothing. No inventory, no employees, no spoilage. You buy it once, plug it in, and it just sits there, quietly charging people $3 to touch their own money. That's the pitch. That's the whole dream. Buy the box, find a wall to bolt it to, and let other people's need for cash become your income. Forever, with almost no work. Except the box isn't printing money, it's holding money. And the second you turn it on, you've quietly agreed to something nobody mentioned in the brochure. That machine isn't a vending machine for cash. It's a vault, sitting unlocked, unguarded, and fully loaded, in a building you don't control the security of. And somewhere out there, someone can empty it in 23 seconds. On paper, getting in is almost insultingly simple. A basic machine runs somewhere between $2,000 and $8,000, depending on how new and how fancy you want the screen to look. You'll need it wired for card compliance and accessibility standards before you can even legally plug it in. But none of that reads as a real obstacle. It reads like buying a vending machine. Bolt it down, get a processor to handle the transactions, and you're an ATM owner. Then comes the number nobody puts in bold on the sales page. Before your first customer ever taps a button, you need to fill the thing with actual cash. Real bills sitting inside a metal box, waiting to be withdrawn. That float typically runs $10,000 to $15,000. And here's the part that trips people up. Technically, it isn't a cost. You're not spending it. It comes back to you, dollar for dollar, every time someone withdraws and their bank reimburses you electronically. It's just sitting there, locked inside a box, doing nothing else, earning nothing else, for as long as you own the machine. Ask anyone selling ATMs and they'll tell you it pays for itself fast. Return on investment in 6 to 18 months, they'll say, and technically they're not lying. What they don't say is that the entire pitch only works past a certain volume. Below roughly 150 to 200 transactions a month, the economics quietly stop making sense. You're paying insurance, connectivity, and processing fees against a trickle of $3 surcharges that barely covers them. So the real barrier to entry isn't the machine. It's the two things that come bundled with it and never show up in the brochure. A 5-figure pile of cash you can't touch, and a bet that enough strangers will walk past your particular wall and need $20 badly enough to pay $3 for it. That's the dream anyway. A box, a float, and a wall. What happens next depends on numbers most new owners never actually run. Here's where most people's understanding of the ATM business stops. Someone pulls out $60, pays a $3 fee, and that $3 lands in your account. Simple, clean. Multiply by however many people walk past your machine in a month and you've got your income. That part's true as far as it goes. The transaction fee is the cornerstone of ATM income, the direct source of revenue for every single withdrawal. But as far as it goes isn't very far, because that $3 is really the first of about 5 layers stacked on top of each other. And by the time you get to the bottom of the stack, the number left over looks nothing like the number you started with. Start with the surcharge itself, since it's the one everyone already understands. Independently owned machines typically charge somewhere between $250 and $350 per withdrawal, and the owner sets that number themselves, within limits, since price it too high and people simply won't use the machine. Price it too low and you're doing all the work for pocket change. This is the layer that gets talked about in every pitch deck and every YouTube video about passive income machines. It's real. It's also nowhere near the whole picture. Underneath the surcharge sits a second, quieter stream, interchange. Every time someone uses a debit card, the card network kicks back an extra 10 to 25 cents on top of the surcharge, paid not by the customer but by their own bank, as the cost of routing the transaction through the network. It's small. It's also the kind of number that sounds impressive when a salesperson says, additional revenue streams, and completely disappears when you actually do the math on 200 transactions a month. 10 cents times 200 is $20. It rounds to nothing. So far, this all still sounds like free money stacking on free money. Here's where the stack starts working against you instead of for you. Running the numbers at $3 a transaction and 200 transactions a month, right in the middle of the industry's own average range. gives you $600 in gross surcharge revenue for the month. $600. That's the number in the brochure. That's the number that gets photographed next to a smiling store owner in a testimonial. Now watch what happens to it. Processing fees take another $20 to $50 a month, just for the privilege of having a company route your transactions to the banks. Cellular connectivity, because most machines dial out over a cell signal instead of relying on the store's internet, runs another $15 to $25. Neither of those is optional. Neither shows up anywhere in the buy a machine, print money pitch. Then there's the layer that catches almost every new owner off guard, because it isn't a fee to a company, it's a fee to a person. Most location owners want a cut. Negotiating how much of the surcharge you keep versus how much you hand over to the gas station or bar or laundromat hosting your machine is a constant ongoing negotiation, not a one-time conversation. On busy locations, that split can run 50 cents to a full dollar off of every single transaction, not off your profit, off the top, before you've paid for anything else. Put a machine in a place people actually want to use it, and the very foot traffic that makes the machine valuable is exactly what gives the location owner leverage to take a bigger bite of it. Run all of that through the same 200 transaction month, and here's what's actually left standing. Net profit per machine typically lands somewhere between $250 and $450. Not $600, not however many fees you can count. $250 to $450. Read that again next to the $600 from a minute ago. That's not a rounding error. That's roughly a third to a half of the headline number, quietly gone before it ever reaches you. And that's the good month. That's the month where the machine works, the connection doesn't drop, nothing breaks, and nobody negotiates a bigger cut mid-contract. There are a couple of smaller streams that occasionally get mentioned to sweeten the picture. Dynamic currency conversion for tourist locations, or small transaction cuts from partnering with prepaid card companies. But these aren't the backbone of the business for a single independent machine sitting in a convenience store in a mid-sized American town. They're rounding, dressed up as diversification. So the honest version of the revenue story looks like this. A surcharge that sounds generous, an interchange fee too small to matter, a location owner who wants a growing piece of the first number, and a processor and cell carrier who get paid whether you make money that month or not. What survives all of that is a few $100s, enough to look like a real side income on a spreadsheet, thin enough that it takes very little to wipe it out entirely. Which raises the obvious question nobody selling these machines particularly wants you to sit with. If the upside per machine tops out around $400 a month, every month, forever, what does the downside look like? So the upside is capped. A few $100s a month, machine by machine, no matter how well you run it. That's not the trap by itself. Plenty of small businesses run on thin capped margins and still make sense. The trap is what sits on the other side of that ledger. Because while the upside has a ceiling, the downside doesn't. Think about what's actually sitting inside that machine. It's not a metaphor. There is real cash, physically stacked inside a metal box, bolted to a wall, in a building with a lock on the front door, and maybe a camera pointed at the register. $10,000 to $15,000 of it on the low end. That box is not guarded by a person. It's not watched in real time by anyone. It sits there, all night, every night, protected mostly by the assumption that nobody nearby knows how to get into it. For most of this industry's history, that assumption held up reasonably well. The risks people worried about were the ones you'd expect. Someone breaks the glass, someone pries the box, a smash and grab that a decent lock and a camera mostly deters. Insurance existed for exactly that, robbery and burglary coverage, built specifically around theft of cash from the machine or from an employee refilling it, a known, priceable, insurable risk. Here's the trap. That risk changed shape, and it changed shape faster than the pitch decks did. The FBI has documented close to 1,900 cases of what's called jackpotting since the start of the decade, attacks where criminals don't break into the machine, they take it over. Over 700 of those happened in a single year, 2025, adding up to more than $20 million in losses. No crowbar, no broken glass. A team gets access to the machine with a key or a panel override, installs malware, and walks away. Minutes later, the machine simply starts paying out, up to 40 bills every 23 seconds. Like it hit a jackpot, which is exactly where the name comes from. Sit with that number for a second, because it's the whole trap in one comparison. Your best month running the machine perfectly nets you $450. A single jackpotting attack, properly executed, empties the entire float, $10,000, $15,000, in under half a minute. That's not a bad month. That's every good month you've had this year. Gone before the store's security footage even finishes buffering. And this is where the trap stops being about crime statistics and starts being about who's actually holding the risk. A bank running 10,000 ATMs experiences jackpotting as a line item, a cost of doing business, spread thin enough across the fleet that no single loss threatens the whole operation. Financial institutions build in insurance specifically because the loss at their scale is predictable and absorbable. But you don't own 10,000 machines. You own 1 or 3 or 5. There's no fleet to spread the loss across. The entire risk sits on exactly the number of machines you actually own, concentrated instead of diversified, which means the very same event that's a rounding error for a bank is a wipeout for you. That's the mechanism underneath all of this. And it's not overhead is expensive or crime happens sometimes. It's more specific than that. This business quietly asks a small individual owner to carry a large, undiversifiable, unbounded tail risk in exchange for a small, capped, ordinary return. It's the kind of trade that looks fine every single month it doesn't happen, and looks catastrophic the one month it does. And the people selling the machines aren't lying about the $450. They're just not the ones standing next to the box when the 23 seconds start. To see how this plays out in practice, you don't have to imagine it. It already happened more than once in ways that got specific enough to end up in court filings. Start small. 1 man, 2 machines, a normal-looking day. Prosecutors in Queens charged a 33-year-old named Eric Salazar Montano with pulling off exactly the scenario described a minute ago. He posed as a technician and manipulated ATMs at a grocery store and a kiosk, then walked away, only to return minutes later with accomplices who removed cash from the machines one by one without ever using a bank card. No stolen PIN, no cloned card, just access, malware, and a matter of minutes. The 2 machines gave up $154,000 and $87,000. Read that again. $241,000 from 2 machines in what amounts to 1 sitting. At $450 a month, the theoretical best-case net profit for a single machine. It would take an owner over 26 years of flawless, uninterrupted operation to net what walked out the door in those few minutes. His attorney later described him publicly as a family man with no criminal record. The machines didn't care. The math didn't care. That's the nature of a tail risk. It doesn't check whether the person on the other end of it looks dangerous. That case is the small version. The large version is where this stops being an isolated crime story and starts looking like an entire criminal supply chain, quietly running through the back corners of ordinary stores. Starting in late 2025, federal prosecutors in Nebraska began unsealing indictments in a case that eventually named dozens of defendants. By early 2026, the Justice Department had charged a total of 93 members and leaders of a criminal network for a coordinated nationwide jackpotting scheme. Not opportunists working alone, but an organized operation methodically targeting machines across multiple states. Investigators say the group used malware known as Plautus, purpose-built to force ATMs to dispense cash on command, and that the stolen funds were funneled to Tren de Aragua, a Venezuelan criminal organization that the U.S. government has designated a terrorist group. Here's the detail that reframes everything. The malware was also built to erase evidence of itself afterward, specifically so bank and credit union staff wouldn't realize a machine had been compromised at all. That means in some unknown number of cases, a store owner or ATM operator simply saw their float come up short one day, with no obvious explanation, never knowing their machine had been part of a scheme large enough to draw a 93-person federal indictment and a terrorism designation. 2 of the men eventually caught in that network, Carlos Javier Padron and Audrey Arnoldo Cabrera Torrealba were each sentenced to 78 months in federal prison for their role, a slice of an operation authorities say caused losses exceeding $5 million just from the machines tied directly to their case. That's one thread of a much larger tapestry. Across the country, similar attacks totaled more than $20 million in a single year. Put the two cases side by side and the shape of the trap becomes impossible to miss. One man in Queens, working with a small crew, cleared nearly $250,000 from two machines in minutes. A continent-spanning criminal network, operating at scale, treated thousands of ordinary ATMs, the same kind sitting in gas stations and bodegas and laundromats across the country, as a distributed, unguarded cash collection system. One machine at a time, funneling the proceeds toward funding an organization the U.S. government now formally treats as a terrorist group. None of the actual machine owners in either case were the ones who profited. They were simply where the float happened to be sitting when the 23 seconds started. So if the owner isn't the one who profits when things go wrong, who is? Start with everyone who gets paid whether your machine makes money or not. The processor collects its fee on every transaction, win or lose. The cellular carrier gets its monthly charge regardless of your transaction count. The armored courier who refills your float bills you the same whether the machine is thriving or barely covering its own connectivity fee. And the insurance company selling you robbery and burglary coverage prices, that policy assuming a certain number of claims will happen across its whole book. Your specific machine getting hit is just one line in an actuarial table they've already priced for. Then there's the location owner, who negotiates a growing cut of your surcharge as leverage, not as risk-sharing. They take a piece of the upside without ever touching the float or absorbing a jackpotting loss themselves. And above all of them sits the real winner, the large-scale ATM network or bank running thousands of machines for whom a $150 jackpotting hit is a rounding error absorbed across the fleet. The exact diversification a single independent owner structurally cannot buy at any price. Best case, if you're the owner, a few $100s a month, quietly, for years, with nothing dramatic ever happening. Worst case, one 23-second window erases years of best cases at once. And the float, the money you were told you'd always get back, simply isn't there to get back, which is really the whole story in one image. Everyone standing around that machine gets paid on a schedule. The processor, the courier, the insurer, the landlord of the wall it's bolted to. Only one person in that arrangement is actually holding the box itself, cash and all, hoping tonight isn't the night someone with a key and 23 seconds finds it first. The machine never stops printing fees. It just never mentions that you're the one ensuring everyone else's cut.